The only people that brag about their credit scores are broke people, confused people, and people that are trying to sell you something. Unlike what the majority of people think, your credit score is not a measure of how much money you make. It's not a measure of how rich you are, and it's definitely not a measure of how wealthy you're going to become. Your credit score shows one thing: how likely you are to pay back your debt. But do you want to know the crazy part? It's not even that accurate. Oh, did you just cancel a credit card? Well, now your credit score just dropped 45 points. You've only had a credit card for 3 years? Minus 61 points. You don't have any debt? You have a 0 credit score. Now, I already know this video is going to upset a lot of people, but I don't make these videos to make friends. I make these videos to hopefully help you be better with money. And if you really want to understand how this credit score system is keeping so many people poor, we got to go back a few decades and understand how did credit scores really become so popular, because it wasn't until the mid-1990s that Fannie Mae and Freddie Mac started requiring credit scores to get a mortgage. Remember them? They had a big hand in the whole 2008 housing market crash. Fast forward to today, and it feels like everybody asks for a credit score from your banker to your landlord, and there are 5 main factors in this order that will impact your credit score, which are: number 1, paying back your debt on time. If you pay back your debt late, you get a ding on your credit score. Number 2 is credit utilization. This means how much credit you qualify for versus how much debt and credit did you actually pull out. So if you qualify for $10,000 worth of credit and then you use all $10,000, that doesn't look good in the credit bureau's eyes. Number 3 is your credit history. How long have you had these credit cards and other forms of debt? If you've only had a credit card for 1 year, well, that doesn't look very good in the credit bureau's eyes. So if you're 17 years old and just getting started, there's not much you can really do about that. Number 4 is the number of new credit applications. If you go out and you apply for a new credit card, well, they dig you for that. Number 5 is your credit mix. What are the different types of debt that you have? Do you just have credit cards? Do you also have an auto loan? Do you also have a mortgage? That looks good in the eyes of the credit bureau because they want to encourage you to have multiple different types of debt. But if you look carefully, what you'll notice is that this doesn't take a look at how much money you make. It doesn't take a look at how much cash you have in the bank. It doesn't take a look at how many investments you have. It doesn't take a look at how much cash flow you're getting from your investments. It just takes a look at, number 1, do you have debt? Number 2, if you have debt, are you paying back your debt? And number 3, how much different types of debt do you actually have? It's just taking a look at the debt factors, but it doesn't actually look at the wealth factors. This is where you see a lot of people unfortunately get caught up in this whole credit score scam, dream. I'm going to show you how you can finally afford that Mercedes-Benz E-Class by improving your credit score. Now, to be completely fair, having a better credit score will help you qualify for a cheaper loan. But the question is, what are you using that loan for? See, there's a whole industry of people out there pitching the importance of a credit score. That way you can have this quote-unquote financial freedom because you can buy a whole bunch of nice and expensive things because you can qualify for that cheaper debt. But that's not how you build wealth at all. Your wealth is not determined by what car you drive. It's not determined by how much credit you can qualify for. It's determined by how much cash you have in the bank, how many investments you have, and how much these investments are paying you in cash flow. That's real wealth. We covered this in Market Briefs a little while ago, but at a time where credit card debt is breaking an all-new record high, and at a time where household debt in America is breaking an all-new record high, the average credit score in America is also breaking an all-new record high. What does that mean? Well, going back to what we said, your credit score, the CS, does not equal building wealth. What your credit score does give you access to is cheaper loans. What do cheaper loans mean for the majority of people? Cheaper loans mean more dumb stuff. And this is where you don't want to do that, because so many people get caught up into this trap that if I have a better credit score, I can have more dumb stuff and show off how I get rich. But this is exactly what you want to be avoiding. Now, for those of you that want to stay up to date on what is happening in the financial news, when it's happening, Market Briefs is a free financial newsletter where my team is working to break down what's happening in things like the economy, housing, stocks, crypto, and the global economy into a fun, witty, and easy-to-read newsletter. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you haven't read Market Briefs yet, I got the link to how you can read down in the description below. But I don't want to leave you hanging here, so let me talk about how you can actually win in this system, because if you want to win in this system, you want to have some dumb stuff. Nothing wrong with that. You want to have a nice car, you want to have a nice home, you want to have some fancy vacations, you want to have some nice clothes, great. Now, the question is, how are you going to buy it? And a lot of people being sold on this dream that you can buy it through cheaper loans. How do you get cheaper loans? Through a better credit score. But that's not the way to go about doing it. If you really want to be able to build wealth, the way that you buy this dumb stuff is with cash. That means without financing it. And yes, that includes not using 0% APR, because all these things are making the banker richer, it's making the companies richer, but it's keeping you broke because you're buying things that you can't afford. Now you're going to say, well, Jaspreet, that means I need more money. You got it. If you want to really become wealthy, your focus needs to be not your credit score, it needs to be on building assets. That means owning investments. That could be stocks, that could be real estate, that could be your own business. You're making money, not spending all your money. You're using the money you don't spend to buy investments. You do this for a little while. I call it a decade of sacrifice. I get it, that's not a little while, but you got to do it for a while. This decade of sacrifice where you're working to spend less and earn more so you can invest your money like crazy. Now what you're doing is working to build up these assets. You're working to build up your real wealth. That way then you can buy more dumb stuff without having to worry about the price. So the question is, when is this type of debt okay? Because for me, if you want to follow my rules, that means you're not financing your car. I know that's hard. You're not financing your clothes. You're not financing your vacations. If it doesn't put money in your pocket, you do not finance it. And the only exception to this would be the home that you're going out to live in. Now, if we're talking about rental properties, we're talking about those types of businesses, then sure, you can use debt, but I don't want to talk about that because I'm not an advocate of that, because most people who go about doing that are going to end up losing because they get caught up into these schemes and scams of how you can just go out and raise a whole bunch of money and start a business or buy a business without knowing what they're doing. And then because you don't know what you're doing, the bank is going to come and foreclose on you. And then they're going to force you to sell this asset that you bought for pennies on the dollar to somebody like me. So that is for, we'll call it a more experienced investor. Not saying you shouldn't do it or that you can't do it, but make sure you understand the risks that are associated with that. So when it comes to you buying these dumb things, buy them with cash, with the exception being at home. Now, I do want to talk about the topic of credit cards here because I use a credit card. I prefer to only use a credit card. And the reason why is because when I use a credit card, I get cash back, I get travel protection, I get rewards, I get upgrades, I get a lot of perks and benefits for using a credit card versus when I buy things with physical cash or a debit card. I don't really even have a debit card. I don't know, maybe I do, but I don't know where my debit card is. So why do I prefer my credit card over debit cards and cash? Because to me, it's just a medium of exchange. When I use a credit card, I don't pay interest. I pay off my entire credit card balance in full every single month and generally early because I never want to have to pay a penny in interest. If you're paying interest on your credit cards, you're doing it wrong and you got to get rid of your credit cards as fast as possible. Cut them up, listen to Dave Ramsey, get rid of those credit cards. But if you are financially disciplined and you know you're only going to spend your credit card on something that you would have if you would have purchased it with cash, well then your credit card is just a medium of exchange. It's just a way for you to transfer money as opposed to you transferring physical bills, or instead of using a debit card, using a credit card. And if you pay it off in full every single month, you get rewarded with some cash back and some other perks and rewards, which can be great because you're not changing your spending decisions because of what you're using. You're just using a credit card. Now, if you're using a credit card and now you're spending more money because you're using your credit card because you want to capitalize on points or perks, or you're using a credit card because now, well, you think that you're going to get rich with points, but you're carrying a balance, you're doing it completely wrong. You're making somebody else rich at your expense, and you got to get rid of your credit cards. So when it comes to things like your credit score, don't get caught up in the game. Okay, I get it. Your credit score is going to help you qualify for a lower mortgage. Your credit score is going to help you qualify for these lower loans, but use this debt strategically. I mean, do you need it to buy a car? Well, why don't you just buy that car with cash? That means you're going to need more money. Yeah, that means you're going to have to be more financially educated. Yeah, that means you're going to have to make more sacrifices. Yeah, but that's going to make you more wealthy. When it comes to buying a home, yes, a better credit score is going to help you qualify for a better mortgage. But guess what? There are ways for you to build a credit score with time. And you just got to understand the game here, because if you just keep playing this game of taking on debt to improve your credit score, you're making somebody else rich. But your goal should be to make yourself rich. And if you can show the income, you can show the cash in your bank, you can show that you pay things on time, you're going to be able to get the things that you want and build your wealth, which is more important than you building your credit score. And now all I ask from you is, if you got some value out of this video, hit that thumbs up button, hit the subscribe channel, and share this video with somebody who you think will like it or won't like it. A simple and basic way to understand if a company that you're thinking about investing in is overvalued or undervalued is by comparing these numbers from one company to another within the same industry. So what I want to do for the purposes of this video is I'm going to compare McDonald's, I'm going to compare Chipotle, and I'm going to compare Yum Brands. So let's start with McDonald's.